The topic that we are starting with is called accounting for taxes. So initially for the first 10 minutes, you might feel that there are a lot of new terms coming at you. But once you get hang of the concept, it's going to be really smooth. So the first thing I want you to know in this reading is, so first sentence you can write down, every organization, and this is a eureka moment for many people, every organization prepares two separate books of account. For ease of reference in this reading, the first book I'm going to call this as the accounts book or accounting book. And the second book we are going to call as the tax book. Accounts book is prepared as per accounting standards. What are accounting standards? Yes, IFRS and US GAAP are two examples. Rule prescribed by the accounting body so that the financial statements are prepared. This tax book is prepared as per, tell me, taxation laws. Now the objective to be achieved, the ultimate purpose of both the books is different. The purpose of accounts book is to represent a true and fair view of the state of affairs and the financial position of the organization. That means they want to represent a realistic picture of what is really happening with the business of the company. Whereas the purpose of tax book is they want to receive as much tax as early as possible. Okay, so the intention why these two separate books are prepared, the purpose behind doing that is the accounting book would give us a true and fair representation of what's happening in the business, whereas the taxation laws generally would want client to pay as much as early as possible. Make sense? Now, because the rules are different, sales and expenses amount would be different. Okay, so there would be different rules for recognition of sales and different rules for recognition of expense. So sales and expenses are different. And because sales and expenses are different, can I safely comment that profit amounts would be different? Do you agree? So profit would be different and profit would be different. And if profit is different, can we also say that amount of tax that we will have in both the books will be different? So tax amount different and tax amount different. But the amount of tax that we actually have to pay, do we have to pay that as per the tax book or do we have to pay that as per the accounts book? The amount that we actually have to pay is as per the tax book. So this is the amount which would be paid. But the expense that we have shown in our financial statements, that would be based on the accounting book. So this is tax expense. And now see what is going to happen. Imagine scenario number 1. So I'm going to write two separate scenarios. Let me plot the first scenario here. Scenario number 1, that as per the accounts book, the amount of tax is 50, but as per the tax book, amount of tax is 70. Are we paying in cash more or less compared to our accounts book? Are we paying more? So you just have to think of this as similar to any other expense that you're paying in advance. For example, if you pay electricity bill in advance, how do we treat that? Prepaid bill. And is that an asset? Yes. So in the same fashion, since the amount of tax that's gone out is more, this is going to be an asset. But this asset is given a fancy name. We are going to call this as deferred tax asset. So the simple rule of thumb that if the amount of tax that you're paying is more than the amount of tax expense as per the accounts book, then we will have an asset. If accounts expense is 50 and tax paid is 30, then in this case we are paying less, and therefore this would be considered as a liability to whom we are going to call deferred tax liability. Are we okay here? So write down quickly. So let's do a comprehensive example to understand how does the DTA and DTL really arise. So you can write this along with me. Let us say we make purchase of a new asset. And the valuation of this new asset, let us say, is 10 million. Now we are going to look at the accounting for this asset in both the financial statements. On the left hand side, I am going to prepare the accounting book. On the right hand side, I am going to prepare the tax book. Now we would assume that in the accounting book, the depreciation that we are allowed to charge is 50% per annum on a straight line method. Which means that asset that you purchased, you thought that the estimated useful life is only 2 years. So let us charge 50% per annum straight line method. But in the taxation book, the taxation law specified that you can only charge 25% per annum on straight line method. So the moment rules are different, we know that profits are going to be different. And because profits are going to be different, the amount of tax paid is going to be different, which is going to lead to either DTA or DTL. So let's see how does it work. This is year 1, this is year 2, year 3, year 4. I am assuming a hypothetical sales. Say this is just an assumption for all the 4 years. The only expenditure that we are going to consider right now is depreciation. How much should be the depreciation here in the first year? How much? 5. How much for the second year? 5. Third year? 0. Fourth year? 0. So 5, 5, 0, 0. That would get us profit before taxes. 10 minus 5, 5, 5, 10 and then 10. Are we doing okay? Let us assume a tax rate of 40%. So tell me what would be the amount of taxes that we would show in the accounts book in the first year. 5 into 40%, how much? 2. How much for year 2? Same. Year 3? 4. Year 4? 4. Now let us see the entries in the tax book. Depreciation. First year, how much? 2.5. Second year, 2.5. It would be same for each of the year. So 2.5 for each of the first 4 years. Profit before tax, 7.5, and amount of taxes, how much? Now let us see what's happening in year 1. Our accountant as per the accounts book, he calculated that amount of taxes is going to be 2. But the tax department, they prepared their own financial statement and they decided that we will be required to pay how much? 3. So from an accounting perspective, from accountant perspective who's sitting here, he will think that expense was 2, but I have paid 3. Have we paid extra? Yes. And when you pay extra, it is a deferred tax asset. So in this year, we will say deferred tax asset of how much? 1. Right? And the simple intuition is that we were supposed to pay 2, but we paid 3. We paid extra deferred tax asset. Second year, is the story being repeated? We were supposed to pay 2. How much we paid? 3. So last year we paid 1 extra. This year we paid 1 extra. Now deferred tax asset is 2. It's a cumulative item. Now see what happens in year 3 and year 4. Now observe carefully. Now this time accountant calculated tax expense of 4, but he said that in the previous years we have already paid extra amounts. So let's set off 1 from the previous year. So the amount that we are actually paying is only 3. Make sense? So now you have in a way adjusted that previous asset. So your deferred tax asset would now only be 1, and this is called as reversal of DTA. And in the last year, again, we are supposed to pay 4, but we are paying only 3. So that DTA will become 0. And this is again called as reversal of DTA. Reversal of DTA. Now let's try to take, are we fine up to this? Which part? Year 3, as per your, I'm repeating year 3 again. Year 3, as per your accounts book, how much is the expense? 4. How much are we actually paying in cash? 3. So what we are saying to the tax department, in the past we have paid extra, set off against that. So how much extra we had paid by year 2? 2. So we set off 1 against that. So now DTA left is only 1. In the last case it would be 0. Make sense? Now calculate the total of sales for all the 4 years in both the books. Total of sales 40. Total of sales 40. Calculate total of depreciation here. How much? 10. How much is the total of depreciation here? 10. How much is total profit before tax? How much is the total profit before tax? 30. How much is the total of taxes? And how much is the total of taxes here? 12. Which means, if you look at this data from a long-term perspective, the amount of tax expense and the amount of tax paid is going to be same. In the long term, it's not going to cause any difference. But within those 4 years, because we got to charge lesser depreciation in the taxation book, initially we ended up paying higher taxes, which we got to set off in the later years. Are you following this? So these type of differences, we call them as, anyone knows the name? Yes, we call them as temporary or timing differences. Okay, you can write this at the bottom of your page, right below the table. Temporary differences, meaning of which is that only in the short term the amount of depreciation or amount of expense is higher or lower. On a longer period it is going to be same. And deferred tax asset and liability is created only and only when there is a temporary difference. We do not create deferred tax asset and liability when there is a permanent difference. So you can write down maybe a sentence at the bottom. DTA or DTL, DTA or DTL is created only for temporary differences. Only for temporary differences. Do you want me to repeat any part here? Anything not clear, please ask. Yes. So right now the question he asked, who asked that? Expenses apart from depreciation, will they also be reduced? Yes. But in this example, we are assuming that only depreciation amount is different, so that it gives us a comparative analysis. See, what she is saying is, we wrote a sentence where we said the purpose of tax book is to make people pay as much as early as possible. Right below that you should write down unless otherwise mentioned. See, for example, let's think from Government of India perspective. Okay, the taxation laws. Should I clear off the screen now? Let us say that this is the accounts book and this is a tax book. There is an organization which has received 50,000 in advance from a customer. 50,000 in advance from a customer. Now this 50,000 in advance from a customer, is this revenue in your accounts book? No, we would typically call this as unearned revenue, and this unearned revenue we will show it as what? Liability. So which means you will have no profit because of this particular item. Do you agree? Since there is no sales, there is no profit. But what taxation laws will say is, in most of the cases, that in this case we should charge tax on a cash basis, which means the very fact that we have received that 50,000, that amount becomes taxable. And since that amount becomes taxable, will we pay more? Yes, and because we will pay more, it would result into a deferred tax asset. Okay, this is a normal scenario. Now imagine an inverse scenario here, that there is one particular type of machinery which Government of India is promoting. Okay, the best example here is research and development type of machineries. So what Government of India wants is, they want a lot of organizations to invest money into R&D, which will help government in the long term. So what taxation law will say is, to incentivize purchase of this type of machinery, that if anyone purchases this machinery, in the first year he can charge 100% depreciation. Okay. So whereas in the books of account, maybe we will charge only 25% depreciation because that machine can be used for 4 years. But in the taxation book, we will charge 100% depreciation. And if depreciation is more, can we say profit is less? Yes. And if profit is less, then generally tax paid is lesser. And if tax paid is lesser, it would be deferred tax liability. Okay. So generally, the general theme of taxation laws, that sentence that we wrote, the general theme is that they want to pay you, they want to make you pay as much as early as possible. But of course, there are scenarios where it works the other way around as well. Are we fine here? Now, give heading in your notes. Temporary versus permanent difference. Temporary versus permanent difference. So this is now, on the left hand side we would prepare accounts book, on the right hand side we would prepare tax book. Let us say there is an asset of 100,000. In the accounts book we are allowed to charge depreciation of 50% straight line method. In the tax book we are allowed to charge depreciation of 100% in the first year. So the amount of depreciation in year 1 would be how much? 50,000. The amount of depreciation in year 2 is how much? 50,000. So over the period of 2 years, total depreciation 100,000. The amount of depreciation in the tax book is how much? 100,000. Second year, 0. So total depreciation over the period of 2 years is 100,000. This we are going to refer to as the temporary difference or timing difference. Maybe timing difference reflects the scenario perfectly. That the total expenditure is going to be same or total income is going to be same. The difference is in terms of timing as to when do you get to charge that expenditure. Now as against this, imagine there is a illegal expenditure. One example that I have come across multiple times in my career is the expenditure towards bribe. Let us say is 100,000. So on every income statement, you would find this section called other expenses. And that's the most popular area to put all expenses like this. Within that, you can classify this as entertainment expenditure or employee welfare or whatever categories. Now, see, in a lot of manufacturing setup, on the ground level, especially if company does not have strong corporate governance, they would end up bribing some amount to the excise officers, customs officer. It's a very common practice with a lot of companies, okay, at least on the smaller level. Now, in the accounts book, they will classify this in year 1 under some head. Okay, so they will have an expenditure of 100,000. But as per the taxation laws, any expenditure which is illegal is not to be deductible. That means you are not allowed to show this as expenditure. So expenditure on account of this in year 1 is 0, in year 2 is 0. This expenditure will never be shown in the books of account, which means there would always be a difference between what the expenditure was in the accounts book and what the expenditure is going to be in the tax book. These type of differences, we would call them as permanent difference. Yeah, that's a good one. He's asking, how does the taxation department knows it's a illegal expenditure? It's very unlikely that they would know. I mean, it's very likely that they would know if they have received it. But yeah, it's just an example, which is exaggerated. But there are many cases. If you get into specific provisions, there are many cases where items are deductible. I think a good example is in India. If you make any expenditure in cash, which is above 20,000, it is non-deductible for tax purpose. Okay, so if you make an expenditure in cash and it's exceeding 20,000 rupees, it is non-deductible except certain scenarios. So then this would result into a permanent difference. Are you fine here?